Welcome to the STR Data Lab.
Hello and welcome to the latest edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at Airbnb, and I'm joined again by our co-host, Scott Sage. Scott, good to see you.
Great to see you, Jamie. And we've been talking about summer, I think, on the last few episodes, and we'll talk the end of summer here, looking towards fall. But I just want to say we are now within 100 days until Christmas.
100 days until Christmas and our 101st episode of the STR Data Lab podcast. What do you think of the 100th episode last week?
So special to hear from the founders of AirDNA, where all this began. It's the reason we even have a platform for the STR Data Lab. So really cool to hear the story from two legends of the industry.
Yeah, it was probably my favorite episode to ever record. I hope sort of our listeners found it exciting as well. And it's nice now to talk with them and not being reporting to them, so I can I could ask the fun and interesting questions that I was maybe scared to ask when they were signing my paycheck. And now they're sort of off doing their own thing. So yeah, it was a blast to record, and I hope people found it fun.
Really well done. Kudos to you on getting to 100 episodes as well. And now we're turning the page for the next 100. And we'll why don't we kick that off with one of our classics here, which is a U.S. market review, and we'll look backwards at August 2024.
Yeah, and this for me is the sort of kickoff of fall conference season 2. So those of you maybe on the hosting side, on the larger property manager side, there is a series of industry conferences. The biggest being VRMA, the Vacation Rental Managers Association Conference. It's in Phoenix this year in October, where it'll get together like 2,000 property managers, vendors, just people in the short-term rental space, sort of talking about industry trends and sort of new tech, new things that are being built for the benefit of sort of everyone in the industry, and then also be in Porto for the Vacation Rental World Summit next week, or sort of as this episode drops, lounging on the river in Porto and presenting at that conference. So industry trends are on my mind, sort of broad, what's happening. Overall, this was a great summer for the industry, both in the US and Europe. And maybe I'll just caveat that by saying great on average. Because we talk a lot about averages, but this industry is anything but average. It's all local. And the trends that are happening in your market could be entirely different than what we're talking about. So this is meant to be, and the podcast in general is meant to be sort of what's happening in general, but as a starting point for everyone to go in and see, okay, what's happening in my local market and how does that compare to average? Because we've got over 6,000 submarkets now on the platform, and over 2,500 of those actually saw a RevPAR decline this summer. So overall, yeah, we saw about a 4% increase in RevPAR for the summer. So that's good. And it was down like 10% last summer. So we're seeing some growth, but we still saw in almost half of submarkets across the country a decline in revenues, or decline in revenue per available rental over the past year, which I think for some people, when they hear us talk about the good news, it's like, well, it's not all good news for
Not in my
everyone all
market.
the
Yeah,
time.
that's
Yeah.
right. I mean, it's sort of like it's really good framing and context setting for anybody listening to this, that it is hyper local. It's the analogy I sometimes use is like the S&P 500, right? We're looking at this from a macro lens.
Yep.
Now, when you actually look under the hood of the S&P 500, you might have 6 or 7 companies carrying the weight, driving the average output. But you have a large swath, and if you look at a quote unquote local level, that are maybe underperforming against average. So a good reminder to go into your own market and use this data as a comparison to what's happening across the macro industry of short-term rentals.
Yeah. And that said, August was great.
Yeah, yeah. Enough of the preface. Yeah, let's get to the data.
August was great. And 12% year over year increase in demand. And now I'm going to give another preface of saying there's a reason why August was so great. And a piece of that was on how Labor Day fell this year. So typically, Labor Day weekend is actually in September. We had essentially half of Labor Day, like the major travel days, actually come into August, which means that August is going to look a bit better. September is going to look a bit weaker than normal. So already, and we're sitting and over almost at the end of September, so we can talk about September as well. But we're averaging demand growth in August. It was up 12% overall. A lot of that in growth was the sort of last 2 weeks of August. And now we're seeing September only up about 5% in terms of demand growth. So I like to average periods over time. I like to look at the summer in general because any one month can have some idiosyncratic things sort of playing into it. So August was good, up 12%. We expect September to be okay, not as good growth. We're going to see occupancy declines in September. Just get prep for it. But we can't get around the fact and we're up good. People are still traveling. Um, I did go and check the hotel numbers too, and just to see just broadly in travel because we are seeing TSA and record sort of airline travel. We are still seeing record demand for hotels as well. And just like short-term rentals, August was a really good month for hotel demand as well, up 2% year over year, where July was flat. So we saw some pull forward in hotels as well. And I think that just broadly makes me feel generally good about travel and that we're even with a looming recession for the past 2 years, even with the election coming up, that people are still traveling and getting out there and spending.
Good, you came around to put the optimistic hat on. You started with
Yeah.
enough caveats there. But I think it does, and I'll put that hat on again, which is, look, this August does represent the fastest monthly increase we've seen since December 2021. So there is an argument to be made about a recovery in the market overall. And that was buoyed, you already called out, by the pull forward of Labor Day as one driving factor. But we did see some other positive trends, like record guest nights. So over these summer months, when you kind of look beyond just August, hosts welcomed 70.4 million guest nights. So a 9.8% increase compared to the prior summer. So there are good buying signals or positive signals in the market overall that this is continuing to grow. And that's encouraging for hosts that demand still persists, exists, and is growing.
Yep. And some things that sort of supported that is we actually saw decent growth in international travelers coming to the US, up 10% year over year.
You've been
So
harping
that
on that for like the past 6 episodes. We're finally seeing it.
finally seeing it. And summer's the time when people are going to travel, and they did. And then to maybe and go a bit into the next topic of with a slowing of overall supply growth, like that equals occupancy gains, which we had been hoping for in 2024, forecasting for in 2024, and actually I'm now realizing in 2024 after 2 years of declining occupancy.
I mean, you mentioned Verma earlier. So these large management companies, managers have long been feeling this 18, 24 months. The continued supply growth has really constrained and put pressure from a competitive standpoint on margins, on bookings, on RevPAR, et cetera. So it's a balancing act because we want to see that continued growth in the industry, but not at the expense of existing operators' performance, right? And so that's where the continued demand has to grow as well to match supply. We've started to see that month over month where those are starting to level out and even see demand outpace supply growth, which is an encouraging sign for existing operators.
Yeah. And not to throw another wet blanket though, we have seen an acceleration in supply growth over the past 3 months. So we reached a low point in June of just over 5% year-over-year growth in available listings. As of August, we're up over 8%. So it does look like we've maybe turned over in terms of maybe June was the low point in terms of new listing growth or year-over-year listing growth, year-over-year supply growth. And now things are starting to pick up again. Like it's maybe a bit too early to say it's a trend, but it's definitely re-accelerated a bit in the past month or two.
Let me ask you the question that's on everybody's minds in this industry and even beyond this industry, naturally. The Fed cut interest rates 50 basis points a couple weeks ago. What should we expect to see as the downstream effects of that decision from the Fed in the STR industry?
Yeah. I think the big thing to note is that that cut in interest rates was widely expected. So I think the only surprise to most economists was that it was 50 basis points instead of 25 basis points. But like what we did though is get further forward guidance from the Fed on how they expect to cut rates going forward, which roughly aligned with market expectations. And so what we actually saw on the day that Fed cut rates was 30-year fixed rates actually go up. And what that shows is that there's what the Fed controls, which is on the short end of the curve, sort of overnight rate that banks can borrow at. And then on the other end of the sort of length of loan is 30-year fixed rate mortgages. And maybe there's a little bit of correlation, but there's entirely different dynamics that sort of impact 30-year fixed rate mortgages. Something that is part of that is expectations for what's going to happen on short rates. And those expectations are all sort of built in. So I don't think 30-year fixed rate mortgages have a whole lot more to move over the next like 6 to 9 months. Like I think we're about 6% now. Like I don't expect them to get that much lower. And as we get through the end of 2024 into the early part of 2025. So this sort of movement though that we've seen in listing growth, or at least stabilization in listings, and you can't get away from the fact that 2 years ago, October 2021 or 2022, we were at like 8% mortgages, and now we're at 6, and that is a great sort of downward trend that does open up affordability for investors today. Over the past year, we were down 1.2% on the 30-year fixed rate mortgage. So things, I think, are starting to open up. 8% was really restrictive in terms of new investment. 6% is significantly more reasonable. And we're seeing that, I think, in terms of investor sentiment today as well.
And so it's a fair assumption what I'm hearing you say, Jamie, is there's a lag associated with the Fed cutting interest rates to a 30-year mortgage as what people would typically utilize in this industry. And we shouldn't assume or just look at, hey, Fed cuts rates. That means it's cheaper and easier to buy a home. Therefore, we should expect to see listings growth. Like that shouldn't happen overnight.
Or I would argue it's even the opposite of like 30-year fix move in anticipation of what the Fed's going to do, because they're essentially predicting that the Fed was going to cut rates. The 30-year fixed rate already had that priced in. And now we see them. I mean, if they didn't cut rates, you would have seen interest rates tick up because they're sort of already priced in that expectation that they were going to cut.
It's a really interesting and important point because I think it's common logic to think interest rate goes down, easier, lower cost of borrowing, easier to acquire property, more listings on the market. And so I think let's just make sure that's clear. That is not what you're suggesting is happening. So I think that's a really important point and appreciate the explanation there.
Yeah. The fun debate though out there, and I want to get your opinion on this, is why the Fed cut 50 instead of 25. There's like the stock market, like the average sort of investor actually was predicting 50, but the average economist, and including me, was expecting 25 basis points. So there's either there's two sort of realms of thought. Like one is like that the Fed is cutting rates that aggressively because they actually think the economy is really weak and they've got to start like propping up the overall economy, cut rates. Like it's what they do during a recession. They cut rates. Like, does the Fed see that we're in recession or going into recession and feel like they need to stimulate the economy? Or is it like, no, like the data just really supports it? Like inflation's really come down. Like we're essentially at target. We've been in very restrictive rate zone before or up until now. Like or continue to now, but like it just doesn't like warrant really restrictive interest rates, and that it now's just the time to start cutting rates, and the data just supports it, and everything's fine.
My assumption here would be the former, which is, the Fed has the best access to this data of anybody, and I would like to think they're making informed and smart decisions. And so therefore, my assumption is they're seeing something in the data that suggests they need to accelerate the cut in interest rates. Because if they were going to do this, right, if they were going to cut 50 or 100 over the rest of this year, they could have just staggered that over 3 or 4 cuts, but they accelerate it to 50. I'm not exactly sure. Like, I don't know why they made that decision, but my assumption would be your former proposal or logic that they're seeing something in the data that might signal recession. But I'm not the economist on this show. So I will defer to your expertise here.
My thought is it's number two. Like, if there was an August meeting, and like this is one of those weird things where they take like the summer off of like having more regular meetings. Like last one was July, then we had to wait all the way to September, like for the next meeting. Like if they could have cut earlier, they would have. They just got more good data
So you think they're playing catch up?
throughout. And yeah, like they probably should have cut in July, but they're already seeing good data. They wanted to see more good data. And maybe looking back, there were some revisions to data that makes them think like, oh yeah, like we could have. And since we could have, like maybe now we just double up on it and then we'll continue to do 25 basis points on the next two meetings in November and December.
Very fair logic. All right, let's get back to some of these August STR report out here. As we look at occupancy trends, Jamie, we saw the first occupancy increase for the summer of 2024 since 2021. Help me understand the drivers of this occupancy growth.
Yeah. I mean, it gets into the components that we talked about. Demand was strong. You look across all the different location types, and we saw acceleration in demand growth from last summer and even from earlier this year. So that's a positive sign. And then yeah, across the board, we saw deceleration in supply growth, and from last year and even from the first quarter. So we had this marrying of increasing demand growth, decreasing supply growth that finally got us to they sort of crossed in the positive direction, which let us see occupancy increases. So and now for the year, just and for expectation setting, we're still only expecting and roughly flat occupancies for 2024 compared to 2023. So our current forecast now for full year is about a 0.4% increase for 2024 for full year. So we're slightly down in the first quarter, slightly positive in the second and third quarter. I think we'll be flat to slightly down in the fourth quarter, so that equals flat. And and that was our forecast going into the year. That it was going to be, and it was written on my whiteboard behind me, the year of equilibrium, finally supply and demand coming into balance. And that's, I think, exactly what we're seeing.
You talked about the locality of this industry. We did see demand increase in all market types, with small city and rural markets showing the highest growth, about 24% year over year for the month of August. Talked about some of the factors as to why that could be. But what are we seeing in this shift in travel preferences from guests that are contributing to this?
I think surprisingly, and we're still seeing a really weak both supply and demand growth in urban markets, and still really strong both supply and demand in the small and mid-sized city markets. And this, I think, continues to and sort of buck expectations of like, and with international coming back, with business demand coming back, that we would be seeing much stronger demand growth in these urban areas, and that we would start to see a pullback in demand in small city and rural. But I think you can't get around the fact that the use cases around short-term rentals has continued to evolve even after the pandemic, and that there's ways that short-term rentals are beating hotels, especially in large listing and 3+ bedrooms and types of travel where a home type accommodation really wins over a hotel accommodation. And then on the opposite side, where as travel's recovered in a lot of these major cities, that if you're going to stay for a night or two, like, hotel's just better than staying in a short-term rental if you're gonna be in the urban core. You're traveling on maybe your company's dime and you don't really care if you're going to save 20 or 30% because your boss is paying for it, not you. Hotel rates haven't grown a whole lot on average recently. And so we've seen really strong hotel demand in these urban areas. We've seen relatively weak short term rental demand. The arbitrage business model hasn't sort of held up, I think, as many as I'd hoped. And there aren't as many sort of large institutional players doing it today as there were in 2018, 2019, which is, and then new regulation has meant that just supply in urban areas just hasn't really come back. We're seeing flat year over year. We're actually seeing falling supply in a lot of major cities. And it just means that, I mean, as guests and are thinking and using short-term rentals, it's much more on the larger property, entire home stay, and we're seeing really strong demand trends there. And then we're seeing for the private room, shared room, or studio apartments in major cities, just weaker demand out there.
That's right. And so we started this episode talking about closing the book on summer. We said we're within 100 days of Christmas. So that means we're moving into fall. What should we expect as our fall outlook here? You talked a little bit about a softening in September given the shift upwards from Labor Day, but how should we be thinking about September, October, November, and December to close out 2024?
Yeah, so September's definitely going to be weak in terms of growth compared to what we've been seeing. So I said, like, first few weeks, we've seen average demand up about 5%, and pacing as of the beginning of the month was essentially flat. So we have seen some pickup in terms of last minute bookings. As we look out into October, November, December, things look a bit better, more normalized in terms of the growth we have been seeing at just north of 10%. So I don't think September is the norm. I think, and sort of October, November, December, getting back to the 10% demand growth is what to expect. And then ADRs, we're seeing pricing trends positive. That is, and we're able to charge more for the same thing that people are getting. That definitely helps on the margins and continue to operate profitably. And I think we're getting away from, as occupancy goes down, people look to compete and compete through cutting price. As occupancy has normalized, we've seen some positive trends again on pricing. And that, more than anything, helps me feel confident going into 2025 that occupancy will at least be stable. We'll at least be able to raise prices associated with inflation, covering additional costs, and continue to operate profitable into the next year.
So just about a month ago, we had a pretty significant price correction on Airbnb stock following their earnings and some concern, primarily driven mainly by analyst concern of a slow booking season in the fall. Sounds a bit disconnected from maybe what we're starting to see in the data for the fall. So help us understand the dislocation between those two data points.
Yeah. Uh, One is just maybe the analyst should have been listening to the podcasts of like
Great
that
plug.
that the growth we had been seeing from 2023, early 24, like was the expectation that demand was going to continue to slow. So, and that is real. Supply has been slowing, and that's a big factor. When we look at Airbnb's business in general, like Airbnb still skews urban. Airbnb still skews 1, 2, 3 bedroom listings, studio bedrooms, private rooms. And when you look at the rest of the industry, listings on Vrbo, listings that are managed by large property managers where people are booking direct, those skew larger bedroom, entire home type properties. So Airbnb exposure as a business does skew more towards the type of demand that we've been seeing weaker performance on in recent months. So you've got to keep that in mind when thinking about the stock, thinking about their business, and that Airbnb is not the industry. And like what we see happening on Airbnb is not necessary. And they still capture less than half the bookings that we see in the overall market. So more than half the bookings for overall industry are coming through other channels. And what we see reported for them and what they report may not be fully representative of what we see happening across the rest of the business.
Very well said. Very clear. I think that's a great way to summarize and put a bow on this episode. If you're listening, you're going to be at Verma. Come say hello. Jamie and I will both be at Verma. You'll see Jamie on stage. We'll be at the Airbnb booth. Come give us a shout.
And I want to give Scott's team a shout out too. If you haven't checked out AirDNA's YouTube channel, we've got a fun docu-series on my short-term rental investment called Jamie's Lane Change. Luke, Austin, William have done an amazing job producing, writing the script, all that sort of stuff. And it's a lot of fun to see come to life. I think we've got 3 episodes released so far. Out of 8 or 10. I forget how many they're actually going to do, but new one coming out every week. Check it out on AirDNA's YouTube channel.
And not to spoil a later episode, but it's apropos timing. Believe you got your first booking today. Is that right?
I did.
There we go. Now we're off to the races.
Yeah, we're officially listed. I've got my uplisting account set up to start pushing through all the channels. And we're rocking and rolling.
Once that pickleball court's finished, the bookings are going to fly off the shelf.
Man, so they promised me that the pickleball court's going to be done the first week of October. The first guest shows up the third or second week of October. So we're in the final countdown to see if everything lines up.
Love to hear it. Go check it out on YouTube to see Jamie's journey. Thank you, Jamie.
Thanks, Scott.